Credit Suisse, one of the largest banks globally and a global powerhouse financial institution based out of Switzerland, has now been officially taken over by UBS. This means quite a lot, and I'll try and break down what it means. But firstly, let's try and take half a step back and try and quickly take you through what led to this takeover. Over the last few years, Credit Suisse has been marred by a series of scandals. There has been leadership changes, blow-ups, and several legal issues, and all of that has essentially led Credit Suisse to a point where there is an extreme lack of confidence. Of course, SVB in the US as well as Signature Bank not aiding the environment either with regard to banking globally, and that also accentuated the problem for Credit Suisse. The confidence problem got accentuated. More deposit holders were pulling out money from Credit Suisse, and that has created a challenge for it. What the Swiss National Bank, the SNB, which is equivalent to the Federal Reserve in Switzerland, has done, they've stepped in, and what they've done is they've brokered a deal with UBS to take over Credit Suisse. The valuation is extremely questionable. $7.5 billion is what Credit Suisse market capitalization was on close on Friday. Talks had already started with UBS immediately after that, and through the weekend the talks closed and the deal has been closed at 3 billion Swiss francs. That's quite a sharp haircut taken by equity shareholders. So that's point number one. Point number two, the deal was brokered with the government of Switzerland in mind, and the government of Switzerland has also agreed to several indemnities as well as several guarantees. So it's a government guaranteed bailout. For the first $5 billion worth of write-offs has been, or rather assumes, UBS assumes the risk for that first $5 billion worth of write-offs. The write-offs after that, up to an extent of $9 billion, has been guaranteed by the government of Switzerland. So that's the larger metric of it. Now, within the terms of the takeover as well, what we're also seeing is that $17 billion worth of AT1 bonds, which are the riskiest set of debt, it's virtually treated as quasi-equity. And if you remember, even in the Yes Bank case, around $1 billion worth of bonds were written off. $17 billion worth of bonds have been completely written off as part of this deal. And this will also impact bond markets. So I will come to that. Now, in terms of the immediate impact, the combined entity will have a workforce of 125,000 employees, which is roughly 30% of the Swiss workforce. And of course, in terms of market impact, it stems off some of the slackened or the increased bit of loss of confidence that the market was seeing, especially with the failures of the US banks, as well as the manner in which the US financial institutions were trending towards. So that crisis of confidence will slowly go away. We did see the US futures in the green as well through early trade today. So that's one big positive coming through. Of course, it also brings with it some amount of stability, some amount of certainty with regard to financial markets, as well as with regard to financial institutions across the world. It gives some stability, it gives an assurance that UBS will completely now absorb Credit Suisse, and the liabilities will be backed by UBS. And of course, what it does, I did mention about bond markets, the AT1 bonds which have been written off. Mind you, they're quasi-equity. So when equity shareholders are given $3 billion worth of money for their equity, which was worth $7.5 billion, currently the AT1 bond holders are given virtually nothing. So the real crisis of confidence will start happening there. Now AT1 bonds, at least the underlying assumption is that AT1 bonds will get pricier because there is a larger a systemic risk of a complete write-off of AT1 bonds without any corresponding large write-off, complete write-off in equity. So actually equity is proving to be less risky than even AT1 bonds, and that ought to start reflecting on the bond yields that will start to play out going forward. So that's one piece that you must keep your eyes out on. The other piece is that the deposit guarantee schemes, the quantum of that will start to get reevaluated going forward, and the combined asset base of UBS in terms of impact is now 1.7 trillion, which is 2 times the Swiss economy, and the bank therefore faces some level of concentration risk. Also, mind you, 25% of mortgage lending done in Switzerland is now concentrated in UBS's hands alone. So that's quite a large concentration risk which UBS now faces, as well as the Swiss banking system as a whole now faces. Now, in terms of the bank as a whole, of course, there are substantial synergies now that the combined now that the entities have decided to merge, and the combined entity will have a workforce of 125,000. There have been several rumors flying around that there'll be mass layoffs, which even the UBS management has confirmed that they're expecting sharp layoffs going forward, but they're not willing to put a number to it as of now. So that's one thing that's open-ended. We'll have to look for a number there. Also, in terms of the combined entity cost base, UBS has suggested that they're going to reduce $8 billion in costs by 2027, which is wipe down costs by half on the combined cost base of both companies. So that's quite a large thing, a large chunk of expenses which UBS is intending to cut off over the next 3 to 4 years. So keep your eyes out on that as well. But at the moment, the positives outweigh the negatives. The positives are that a bailout of sorts, at least, has been initiated and finalized, and the global financial system is currently steady on the back of that.
If you like this video, then like, share and subscribe to ET Now.